Okay, let's make a start. Good morning, everybody. Thank you so much for joining, and thank you for joining in such numbers. We have been absolutely overwhelmed by the demand for this webinar, which is absolutely brilliant. We've had nearly 15,000 people register, which is absolutely incredible, and I can see the numbers of people joining now well up into the thousands. So thank you so much for giving up some of your Thursday morning. My name is Brian Burns. I'm the head of personal finance here at Moneybox. We expect this session to run for about 45 minutes to an hour. One of the questions that we got quite frequently coming in was, will there be a recording available? Absolutely, there'll be a recording available. You should get a link in the next 24 to 48 hours. So if you can't join for the whole session, that's not a problem. We did get some feedback last time saying that the session was actually too short when we ran it for about half an hour. So we're aiming for about 45 minutes to an hour this time. Unlike the last webinar that we ran, we're not actually expecting a fire drill this time. So if anything happens there, it is not expected. And then the last thing I need to say before we get started on the content, it should be relatively clear given that there are thousands of you on this webinar, but nothing that you hear today is individualized personal financial advice. It is guidance, it is education. We are here to help you make your own investing decisions, but hopefully make you feel more confident about those decisions by the end of this webinar. So what exactly are we going to cover? So when you registered, we asked you to submit some questions, and with those questions were some themes, and those themes were getting started investing, help choosing investments for yourself, and also what's happening with investing in 2025. Well over half of the questions were focused on just getting started, which is completely understandable. So we're going to spend quite a bit of time there. We're going to look at things like, what accounts do I choose if I just want to get started investing? How do I choose my first investment? And how do I choose an amount to get started with as well? We're then going to look at the next most popular theme, which was some variation of, is now a good time to invest? Again, it's a very frequent question that we always get. So we're going to spend some time on that. And a natural follow-on from that is, what have investments done so far in 2025? So we'll spend a little bit of time on the current investing environment. We will finish off then with some Q&A. We had 1,500 pre-submitted Q&A questions, so we had quite a lot to choose from. There is also a Q&A function in Zoom, so if you want to pop some questions in there, if we have some time at the end, we might cover off those. Always gives our compliance team a little bit of a heart attack when we try and do those live, so maybe we'll try and do that at the end. But let's make a start. So let's get on to the real basics. What is investing? Investing is using your money to buy something that you hope and expect will go up in value over time. That is the most basic definition. You buy something today that you expect at some stage in the future you can sell for more money. The list of things that you can buy with your money is obviously endless. You hear about all sorts of things like cars, houses, wine, whiskey, you name it, you can invest in it. Most commonly, when people talk about investing, they're talking about investing in companies, which is also known as investing in stocks. All of these things together, as we try and cut through the investing jargon, are commonly known as assets. So whatever you invest in is an asset of yours. It's absolutely vital that you remember, when you are investing in companies, you own something. We in the UK are very tied to investing in property. You always hear people talk about, oh, I'm investing in something that's bricks and mortar. I can see it, I can feel it, it's tangible. You must remember that that is the same when it comes to investing in companies. You are owning something tangible, you're owning something that you can see and feel. It's just slightly less obvious than when you are investing in property, for example. You own a share in a company. The value of that company can go up and down, but at the end of the day, you still own a share of that company. That's a really important thing to remember when it comes to investing. And we'll touch on that quite a bit as we go through the content today. Now, as you can see on the screen, the stats about how many Brits invest aren't great, and Moneybox is on a mission to change that. This is not necessarily because people don't know what investing is. That's certainly a factor, and we are trying to change that. But Moneybox as a platform has been around for about 10 years now. So we've conducted a lot of research and we have a lot of insight from customers over the years about investing. And the most important thing that we have found when it comes to starting investing and also sticking with an investing plan is confidence. That's one of the main barriers that is stopping people in the UK from investing, is the confidence that you have to make the initial investing decisions and also stick with your investing plan. And again, we are on a mission to change that. When it comes to improving your financial confidence, the number one thing that you can do is spend time on your finances. Unsurprisingly, that directly correlates with becoming more financially confident over time. And that can be things as simple as working out what your own financial goals are, which we will touch on a little bit more in the future. It can be reading financial blogs or newsletters, or it can be just tuning into a session like this. Just by doing this today, you are hopefully taking a step to improve your financial confidence and therefore hopefully improving your investing outcomes over time. And given the number of people that we have registered and dialed in today, I myself have a lot of confidence that we can change these figures over time. So let's get started by seeing where you are today. I want to get a little bit of an idea of where people are in their investing journey. And this is going to rely on me and my tech abilities by putting a poll up on the screen. So give me 1 second. Hopefully, I have now launched a poll, which you can see. Yes, I can see some answers coming through, which is fantastic, which means all the tech is working. So I'm just going to have a very quick drink. Excellent. Seems to be a relatively even split across. There's still a huge number of people voting, but this is quite like Eurovision, actually. But I'll end the poll here. The most popular one is I have cash savings, but I don't currently invest. Next most popular was I invest, but I don't feel the need to check my investments regularly, which is absolutely great. Next was I'm trying to build up my cash savings and hope to invest one day. And then 16% of you actively pick your investments and review them as often as you feel necessary. That's really good to see. And actually, we have tailored the content for today very much in line with those results, which is absolutely excellent. Looks like I can share the results there on the screen for you to see. And there'll be a few more polls like that coming up later on. Excellent. So for those of you that are either building up your cash savings or trying to get started, this will be the section for you. Just starting with another piece of research, and it says that 25% of British people who have financial regrets say that they regret not investing. And whenever we ask people what their regrets when it comes to money is, not investing is always very high on the list. So that's why we've dedicated a bit of time in this next section of just how to get started. So for those of you that have already started investing, you know that this was quite a tricky step. And again, it could be tough with the variety of options available to you to get started and the choices that you need to make to feel fully confident in those decisions. So let's go through how to get started investing. So here are the first couple of steps. The first step that you need to make a choice on is your choice of provider. Now, I'm going to make an assumption based on the fact that you are logged on and listening in to a webinar from Moneybox that a lot of you have already made this choice. So I'm not going to dwell massively on the choice of provider. The things that you need to look out for is the quality of service that you get from the provider, the fees that you're paying, the various different account options that might be available. So I won't dwell too much on that first section. The next thing that you need to do is selecting an account. And from the questions that we get in for these webinars, this can seem like there's an awful lot of choice available here, and it can feel a bit scary sometimes to choose the right account. But whenever I'm talking to people about their financial plans, what they want to achieve with their money, I always say the very first step is really nothing to do with providers or accounts. It's working out your financial goals. And that just means, what is your money for? What are you saving for? What are you hoping to invest for? What are you working for? What is your salary kind of going towards? Just taking a step back and thinking what your money is for. And that will be different for different people. Many people who are saving with Moneybox are hoping to save for their first home, so get their deposit together. Many people are hoping to save for a comfortable retirement. People are hoping to save for their children. And many people are just hoping to build wealth and beat inflation over time. These are all perfectly valid financial goals, but it's very important to work out your financial goals and what motivates you to save. The reason that it's so important is it makes that next step of choosing an account an awful lot easier, because we're quite fortunate here in the UK where there are basically dedicated savings and investing accounts for whatever your financial goals are. So for those people who are looking to save for a house, for example, you've got the lifetime ISA, which will help you towards that goal. If you're looking to save for retirement, you've got pensions, which are very tax advantageous to save for that. If you're looking to save for your children, you've got junior ISAs. And then given that we're on a webinar talking about investing, if your goal is just to invest, build up wealth, try to beat inflation over time, for most people, the stocks and shares ISA will be the best account to look at and to start with. Because with the stocks and shares ISA, you can save or invest, you can put in up to £20,000 per year. And anything then that grows from there, or any income that you get from your investments, is completely tax-free. So, as I say, when it comes to choosing an account, really the question is, what am I saving for? And then what account maps across to those financial goals? You can have multiple of these at the same time. So you can have a stocks and shares ISA, a cash ISA, a lifetime ISA, all at the same time. Really, the key rule when it comes to ISAs is the maximum contribution limit is £20,000 per tax year. There's a lot more about this on the Moneybox website and the app. You can see the definition there of stocks and shares ISA. But really, the key point here is working out what your financial goals are. Then the next step is, right, okay, let's assume that you've got your stocks and shares ISA. Then you need to decide what can you put in it. And this is about choosing an investment. If we work from the individual companies and up from there. So I talked about earlier, what is investing? And it's investing in things that you hope will go up in value over time. And most commonly, when we talk about investing, that's investing in individual companies. So names that you might know over in the States, like Amazon or Microsoft, for example. In the UK, you've got Rolls-Royce, for example, just a UK company. You're investing in those companies, you're investing in the individual companies themselves, and you own a slice of that company, you own a slice of all of their assets, you own a slice basically of their future income. Now, as that might suggest, that's not a particularly diversified way to invest. You are purely invested in that one company, or maybe you're invested in multiple individual companies, but you're still pretty exposed to what happens with those individual companies. Investing in a fund basically is more or less the same thing, but you put your money into a collective fund, and then that fund invests in multiple companies themselves. So you can have funds that invest in every single company in the UK, for example, every single company in the US. And as the names would suggest, or as that description would suggest, you're a lot more diversified by investing in a fund. And that means the ups and downs aren't quite as volatile as when you're investing in an individual stock. Now, I gave those examples of the individual funds, and you can invest in funds that are exposed to one particular country or one particular sector, and they are more diversified than investing in individual stocks, but they're still not globally diversified. All the funds are not necessarily globally diversified. So if you don't really want to make any of these choices, basically with any provider that you choose, they will have some sort of ready-made, off-the-shelf, very diversified option available to you. At Moneybox, this is what we call our starting options. These are incredibly popular with our customers. You basically just go in and you can choose either a cautious, balanced, or adventurous starting option. The names do kind of exactly what they say on the tin in terms of your risk appetite. And these starting options are incredibly globally diversified. So they invest in multiple funds and invest in thousands of companies across the globe. So those are essentially your three choices. And it all comes down to how diversified you want to be. And generally, when it comes to investing, the more diversified you are, the better in terms of the volatility that you experience. We actually came up with a new definition of diversification just for this webinar. And you can think of diversification like eating one piece of fruit versus a fruit salad. If one piece of fruit is isn't fresh, it might be a bad experience. But in a fruit salad, if one piece is a bit off, there are other fruits to enjoy. If you enjoyed that definition, then it was me that came up with it. If you didn't, thank Callum in our investing team for that one. But the crucial part here is diversification is very important. Now, the third and final step, there are only 3 steps to starting investing. And then this one is about choosing the amount that you need to put in. And this really, the choice between the 2 options on the screen here, regular investing and lump sum investing, people worry about this far more than they need to. the choice for you is really dependent on your individual circumstances. Regular investing is an absolutely fantastic way to go. If you are in traditional salaried employment, and by that I mean you get a wage on a weekly or a monthly basis, setting up a regular amount that goes into your investing account is absolutely brilliant. If you're not in that scenario, if you're self-employed, for example, or if you have received an inheritance or whatever it might be, lump sum investing is absolutely fine. In an absolutely ideal world, you would probably do a little bit of both, but it is really down to your personal circumstances, choosing whether you look at regular investing or lump sum investing. Now, regular investing in particular has a couple of very positive things about it. If you're investing a regular amount on a monthly basis, let's just say you're investing £250 a month. The good thing about setting that up and having it done automatically for you, so you pay it out of your paycheck on the day that you get paid, it removes all emotion out of investing. You don't need to worry about what investing markets are doing at that individual time. We'll touch on this a little bit later. Over the short term, investing markets can be up and down, but if you're investing a set amount on a regular basis, you don't need to worry about that. The other benefit that regular investing has is something called pound cost averaging. And it can feel like investing jargon, but basically it means if you're investing the same amount on a regular basis, on a monthly basis, you get more for your money when markets are down than when markets are up. So when markets are down, you just get more for your regular £250. You get more shares in that company because the price is lower. And that is something that over time works massively to your benefit. So regular investing is very positive, but don't worry too much about it if your circumstances don't allow that and you prefer to do lump sum investing, or that's just more preferable to your circumstances. So those are really the only 3 steps when it comes to investing. And that is choosing the account, choosing the investments, and choosing the amount that you want to get started with. And hopefully we have broken those down to as simple as they possibly can be. I've probably rattled through them relatively quickly, but I did mention there'll be a recording available, and there's lots of information about these on the Moneybox website and the Moneybox app. Now, I'm just going to briefly touch on this testimonial from an existing Moneybox customer. The reason that I'm doing this is we got very specific feedback last time that of the last investing webinars that we did not highlight the Moneybox features or the way of investing enough. Hopefully this goes some way to fix that. And it might even reassure some of you who haven't yet started investing with Moneybox, but have been thinking about getting started, that Moneybox is a great place to do that. But I'm not going to dwell on that too much. What I am going to go on to is the next poll question. And given how much I said the importance of confidence is, the next poll question is about financial confidence. And I want to understand how you feel and how confident you feel about investing today. So I've launched that one on the screen. I can see some answers coming through, and that means I can take a drink. I am astounded by the number of people on this call. Thank you very much for the support and joining in on a Thursday morning. It's absolutely brilliant, and it does give us confidence that we are doing the right thing when it comes to investing, and we can hopefully make people more confident investing over time. Okay, I will end that one there. I will share the results, and it is basically representative of where we feel the UK population is when it comes to investing. So 37% of people said slightly confident, 26% said fairly confident, 20% not at all, and then 14 and 3% heading towards quite confident and very confident. So hopefully via this session, but not this session alone, and the rest of the work that Moneybox do, we can hopefully make people more confident investors over time. Okay, let's move on to the next section. Is now a good time to invest? Short answer on this one is yes, but we will go into that in a lot more detail now. There are a couple of things that you need to consider before you get started investing, a couple of things that you need to tidy up with your own personal finances. First of all, it's a very good idea to have an emergency fund in cash saved somewhere for, as the name would suggest, emergencies when they crop up. Typically, you should be looking for about 3 months worth of expenditure in that emergency fund that you can readily lay your hands on, as I say, if anything happens to your employment, for example. And that should be set aside somewhere. You hope you never have to use it, but it is there for you. That should always be your first step. You should also be looking to pay off any high interest debt. By that, I mean things like credit cards or loans, for example. The reason on that is the interest charged on credit cards and loans is typically quite a lot higher than what you're going to get back from investing. So the most financially sensible and prudent thing that you can be doing is paying off any high interest debt and making sure that you're not paying too much interest over before you start investing. And then the third thing that you need to think about, we'll touch on this a little bit more in a minute, is your time horizon. And all that means is how long do you think you can invest for? So typically speaking, you should be investing for at least 5 years so you can ride out market ups and downs. And basically, any money that you're putting into an investing account, you shouldn't think, oh, I need that in 2 or 3 years for a holiday or a wedding or to buy a car. This should be money that you can put aside for a little bit longer than that. So if you're thinking that your financial goals are a little bit sooner than that, that's not a problem, but you should probably be thinking about things like a cash ISA or a savings account over those type of time periods. So those are the things that you need to be thinking about before you get started investing. Having said that, another piece of Moneybox research shows that 31% of people who do invest regret not doing it earlier. So hopefully, as you say, what we can do via today is give you the confidence to get started. But if anybody is feeling anxious that you haven't started investing already, even people who did start investing, it does take people quite a while to get confident enough to take that step. Sometimes it can feel like investing is some sort of exclusive club, but it really isn't. With Moneybox, you can get started investing from as little as £1, and that can help you build up your confidence over time. Another question that we often get is, do I need to be investing large amounts in order for it to be worthwhile? Absolutely not. Even if you can only get started with really small amounts, that's absolutely fine because A, you're an investor. B, hopefully that takes the kind of fear out of things, of taking that first initial step. And then it also massively builds up your confidence and experience over time so that hopefully in the future, if you've got more money to invest, you don't have to take that scary initial step because you'll have been invested with smaller amounts for quite some time beforehand. Okay. This is a chart that we created specifically for this webinar. And essentially what this chart is trying to show you is there's never a perfect time to invest. The important thing is just about getting started. So everything that we are experiencing from a news cycle perspective in 2025 feels quite unusual. And that's because it is. The news cycle is never exactly the same as it was before. But from an investing perspective, markets have been through all of it and worse things before. Markets will rise, they'll fall. That is all part of investing. The problem is the negative periods of performance when it comes to investing markets capture far more attention than the positive periods of investing when you're investing. Markets go up far more often than they go down. But as I say, when they go down, it tends to make headlines on the news, on newspapers, on social media. Whereas the periods where markets just kind of quietly go up in the background tend to get a lot less attention. This is also why the 5-year time horizon is important. Even when markets do go down, and sometimes they can go down significantly, they have typically always recovered as long as you're looking to invest for the long term. So picking out just a couple of things on the chart here, you can see the coronavirus pandemic. Markets went down very quickly at the start of 2020, but they recovered very quickly as well. So it's really important to maintain that 5-year time horizon. You might also be asking the question of why do markets and investing, why does it typically go up over time? You can see on this chart, this is a 30-year time horizon. By the way, this is the valuations of, it's something called the MSCI index. It's basically the 6,000 biggest companies in the world. And you can see over the last 30 years, yes, they've had some ups and downs along the way, but they have gradually increased in value over time. The reason that markets tend to go up over time is that companies are just very good at innovating and making new products. Sometimes companies fall away and new companies will come in and replace them. But that innovation, both for companies and on an individual human basis, that is why markets have gone up and have gone up for decades and decades and decades. Yes, there will be some hiccups along the way, but generally speaking, companies are extremely good at adapting to any economic, political, social conditions that there are, and very good at making profits and returning value to people that own shares in the company. Another thing that I wanted to touch on here is if we go back to you owning an individual share in a company, basically what the market does is it offers you a price for that share of a company on a daily basis. Now, there'll be many people on this call who run their own businesses, who own limited companies, are directors of companies, whatever it might be. And basically what the market does is it knocks on your door every single day and it offers you a price to sell that share of that company. Now, if you're owning your own company, you know exactly how much it's worth. You know the profit that it's making. You know what the future prospects are like. And if somebody knocked on your door and offered you 50% of what you think the company is worth, you would close that door and you would say, no, thank you. I will hold on to my shares. That is exactly what the market is doing on a daily basis. So when you see, as is potentially does happen, the share price of something that you're invested in go down, all the market is doing on those days is offering you a lower price than they did the day before. There is absolutely no obligation for you to sell during those kind of periods. It is just an offer for the share of the company that you own. So sometimes it's important to think about that. There is an offer price always available to you, but there is absolutely no obligation. And you need to think about, okay, this investment that I hold, do I still hold it for the same reasons that I did last week? Then if so, it's no difference to you whether the market price, the price that they're offering you to sell, is a bit lower than it was last week. And over time, as we can see by the chart, it does tend to go up over time. So important to think about that when markets do go down. It is purely just an offer price. Now, investing performance in 2025 so far. It's been fun. So I'm not going to go through each one of these individually, but in the UK, we have seen quite a bit of noise. There's been quite a lot of news when it comes to investing. Some things have made the front pages of newspapers. Some things have made the headlines of the TV news. Some things have been all over social media. For example, the tariffs that we have seen over in the US and the subsequent rebound since then. We have also seen interest rate decisions. We have seen announcements about inflation. All of these things do impact investing markets on a short-term, day-to-day basis. One of the things I really want to call out here is May the 2nd. And this is what I mean by positive periods of investing performance rarely get the same coverage as negative periods of investing performance. So as of May the 2nd, the FTSE 100, which is the 100 biggest companies in the UK, you can invest in funds that track the FTSE 100. So you invest a little bit in the top 100 companies in the UK. On May the 2nd, it recorded its 15th straight day of positive gains. So every day for 15 days, the value of all of those companies increased. That was a record. It's not something that's necessarily typical. Usually what will happen is you get a couple of days of positive gains, then it will drop back a little. Maybe you might get 3 or 4 days. You might also get 3 or 4 days of negative performance. But May the 2nd marked 15 straight days of the UK stock market rising. And that is not something that I saw any headlines about. But of course, a month before, when we did get the tariffs from the US and markets went down, you did tend to see quite a lot of headlines about markets falling. And this is just the discrepancy that we always have. And we at Moneybox will always try and give you a balanced picture of exactly what is happening with markets. So you can see that here on the screen. And you can see at the start of April, a relatively big dip in the FTSE 100. Again, the 100 biggest companies in the UK. But you can also see that gradual recovery since, which tends to get an awful lot less coverage. The FTSE 100 so far this year, despite everything that I talked about, and you just would not appreciate this if you were just looking at headlines, the UK stock market is up over 6% so far this year from the 1st of January. If you zoom out again, this is why we talk about that 5-year time horizon. Going back to January 2020, the FTSE 100, the 100 biggest companies in the UK, is up 46% over that time period. Crucially, the numbers on the screen here do not include dividends. Now, what are dividends? So when companies are making money, so they're selling goods and they're selling services, they'll make a profit. They have a choice of what to do with that profit. They can either reinvest it into their company, and they can hopefully make more profit going forwards in the future, or they can pay it out to their shareholders and their investors. And this is what's called dividends. Owning the FTSE 100 companies over the course of the last 5 years, typically speaking, you've been paid about 3 to 4% a year in dividends from FTSE 100 companies. So as I say, FTSE 100 is up 46% just in terms of the valuations, the prices, and you've also been paid 3 or 4% dividends per year just for owning the FTSE 100 companies. So really important to remember that there. And whenever you're thinking about investing, and maybe you get a little bit nervous about short-term performance, always take a step back, always zoom out and say, okay, what has the investment performance been like for 5 years? And can I leave these funds invested for 5 years kind of going forwards? Because yes, investing can be volatile in the short term, but actually it's a lot calmer than people realize over the long term. So that's why the time horizon point is so very important. Over in the US, lots of things have happened, many of them political, which I won't dwell on too much, but I did reference the tariffs before, which did create quite a bit of market volatility. Again, over in the US, there was decisions about interest rates, inflation, but most of the story in the US so far this year has been about tariffs. And you can see, generally speaking, a relatively similar shape of the graph. The US market has not quite recovered to the same extent that the UK one has. And this is why that diversification that we talked about, not just investing in a fund that only invests in the US, also investing in ones that invest globally in different countries is so very important. But even the US, which you probably wouldn't tell via the headlines, is up so far in 2025. Only up 1.2% compared to 6% in the UK, but it is still positive. And again, when you zoom out, you can see that the US market has been extremely positive over the last 5 years. So up over 100% over the last 5 years. And again, this does not include dividends. One thing that I want to talk about that isn't on the screens is when you're investing in the US, you are investing in a different currency. And that this can get a little bit complex, but if you just think about it, about when you're going on your holidays to Europe or the US, we know that we spend over there in euros or in dollars. The same thing happens essentially when you invest in individual US companies. So if you invest £100 in Apple, for example, you are not just investing in Apple itself, you are also converting your money over to dollars. And then when you need it at some stage in the future, then you need to convert it back to sterling. When you're investing in individual companies, there's not really too much that you can do about this. It's just something to be aware of. And similar when you're investing in funds, there are some what are called hedged share classes where you just don't have to worry about the currency side of things, but that's probably beyond the scope of this webinar. All you need to think about for today is just remember that when you're investing in the US, the currency difference between sterling and the dollar and what that does is also an impact on your investing returns as well as those individual companies themselves. You obviously don't have that issue when you're investing in the UK because you're investing in companies in sterling. So it's just a factor to remember. Okay. Let's just touch on this slide just one more time with the context of everything that we've talked about in 2025. So the news cycle in 2025 it's incredible in terms of everything that we've seen so far this year. Quite a lot of negative news and quite a lot of things that have caused significant headlines. From an investing perspective purely, things like the tariffs, when you think about it from a 30-year time horizon, if we look back on a chart like this in 5 years' time, the fall that we saw after the tariffs were announced will barely register on a chart like this. You will see a small down, and hopefully if markets continue to go up, and as I mentioned, companies continue to innovate and sell products, it will look like a small blip and then a recovery going forward. So always absolutely vital when we think about investing to zoom out and think about things over the long term rather than what is in the newspapers or on social media feeds on a day-to-day basis. So how do we put all of that into practice? There's really only three things that you need to do. So you need to pick an account, and that is basically the one that is most aligned to your financial goals. You need to choose your investments. So you can either choose a starting option or you can build your own portfolio if you want to. And then you need to decide on an amount that you are going to invest. Those are the only three things that you need to do to get started investing and be one of those investors and not have the financial regrets that we talked about before. And just to bring that into light, on the screen now, you can see the performance of our balanced starting option. So this is the medium risk starting option over the course of the last 10 years. And yes, you can see there's a couple of years where investing performance didn't go particularly well, but you can see plenty of positive years as well. And over the course of that 10 years, we saw an average annual return of 9.1%. So significantly above what you could get on cash savings over that time. There is absolutely nothing wrong with cash savings. As I mentioned, we all should have an emergency fund. Anything that you're planning to spend in the next 2 to 3 years should be kept as cash, and only things that you can put aside for 5 years plus should be invested. But all of the stats that we have seen, all the stats that we see about how UK people hold their money, we should over time be aiming for a better balance between cash savings and investing. And it is really quite simple to get started. So now we're going to do a couple of polls back to back. And the first one is for people who don't invest currently. So if you do invest currently, please leave this one alone, and there'll be a question for you in a minute. But I've popped this one up, and I'd just like to know, if you don't invest, what the reasons are for that. And if you do click other, that's absolutely fine. Please just pop it into the chat or pop it into the Q&A, what those other reasons are about not investing. Okay, I'll end this one and I will share the results. So as you can see on the screen, the most popular one is, I don't feel I know enough about it. First of all, congratulations for taking the incredible step of coming onto this webinar and trying to educate yourself about it. This will probably be a first step in that journey of learning more about investing. We may have covered things off quite quickly this morning, but as I say, there will be a recording available and we will do many more of these webinars in the future. Becoming more confident about investing is very much a process. You're not going to read one article, listen to one podcast, join one webinar, and suddenly become really confident about investing. In the role that I do at Moneybox, I often get asked for tips or hacks or whatever it might be. And the one thing that I say is probably a little bit dull, but it does work. And that is spending 30 minutes a week on your finances. And that can be about saving, investing, finding out where your pensions are, whatever it might be. But it just indicates that's the level of consistent effort. And as I say, 30 minutes a week, hopefully most people are able to carve that out. And over the course of the year, that's 26 hours. And you will be amazed about how much more confident you feel, how much more you know about investing if you can just carve out that 30 minutes a week. The next one that came up was, I'm scared of losing money. Hopefully we've touched on this quite a bit, but yes, markets do go down in the short term. But if you're scared about losing money, the number one thing that you can do is just expand your time horizon and invest hopefully for a long period, at least 5 years. And then plenty of people building up their savings first, which is a very prudent step to take. Okay, and now we will switch over to the poll for people who have started investing. And I'll pop that up. I'm just interested in your financial goals on this one. I don't think we've covered off every financial goal. So if you do click other, please, as I say, just pop in the chat or the Q&A what your financial goals are. Excellent. So 24% saving for a specific goal, buying your first home or an early retirement. The top two then are linked. So I'm after a higher return than cash savings and I want to have financial freedom in the future. The reason that investing is so important for both of those is that historically speaking, investing has been a much better protection for your money against inflation than cash over time. As I say, perfect place for cash accounts when you're saving for the short term. But over the long term, one of the most important financial goals that you need to have is to try and beat the rate of inflation over time. We have had a very harsh lesson in the UK about inflation over the course of the last 2 or 3 years with the cost of living crisis. Inflation peaked at 11% 2 or 3 years ago and has creeped up again with the latest numbers that came out yesterday showing that inflation is now running in the UK 3.5%. So that means things are getting more expensive every single year. And in order for your savings to be able to buy the same amount of things next year or in 5 or 10 years' time, you need to try and beat that rate of inflation. Typically speaking, over the longer term, investing has been a better route to doing that than cash savings. So that's why investing is vitally important to getting a higher return than cash savings and wanting to have financial freedom in the future. Excellent. Thank you very much for those polls. We're now going to move on to the Q&A section. And these were some of the top questions that we got from our customers. Some of them were literally just the most popular ones that we got through. And then some of them were just ones that really interested us in terms of feeling like they were very important to answer. So we did get a lot of questions about the ISA allowances. There has been a lot of speculation in the media and the press about what will happen with ISA allowances going forwards. So I referenced at the very start, at the moment, you can invest £20,000 a year across your various different ISAs on an annual basis. If you want to, you can put all of that 20,000 into a cash savings ISA, or you can put 20,000 into a stocks and shares ISA. Now, what has been rumored is that the government are looking to encourage a better balance between cash and stocks and shares. At the moment, the UK, we hold most of our savings in cash. We are a nation of absolutely brilliant cash savers, but we don't quite have that balance right. And there is speculation, I must say it is only speculation at this point, that in the future, the government may restrict the amount that you can put into the cash side of the ISA to encourage more people into the stocks and shares version. Now, this is speculation. Nothing has been announced yet. If there is going to be anything announced, it will most likely be in the budget this autumn, so some stage in October or November. Most likely, if they change anything, it will be for implementation April of next year. So we have plenty of time. And also, if they announce anything, it is highly likely that anything that they announced would just be forward-looking. So there is absolutely nothing right now that you need to do based on this speculation about your current ISAs. It is just worthwhile keeping an eye on the news, and Moneybox will keep you extremely well informed if there are any changes to the ISA allowances going forward. But currently, nothing to be concerned about and no changes that you need to make to your savings right now. We got a lot of variations of, am I too old to start investing? Short answer to that is no. We have people saying, I'm 32. Am I too old to get started investing? We have people saying, I think it went up to 82. Am I too old to start investing? And again, the answer is no. It is crucial. The time horizon piece is really the question here. So if you're going to be investing, hopefully for 5 years, it really doesn't matter how old you are. You can always get started investing as long as you have that 5-year time horizon. We got one question in saying, do roundups really count? Those of you that have been with Moneybox for a while know that we offer a roundups feature, so that if you are out and spending, you can round up your spare change, and that can be saved or invested for you. Simple answer is yes, they absolutely count. And when it comes back to when choosing the amount to get started with, roundups are an absolutely fantastic way to get started because they are a relatively small amount. You don't necessarily feel it or see it coming out of your bank balance necessarily. But again, it turns you into an investor, and it makes that first step about getting started investing feel a little bit scary. Typically, on average, we have seen with Moneybox, people investing about £12 a week just by rounding up their spare change, just by turning on that feature. And that then goes up to about 600 quid a year, which is absolutely a brilliant amount to be getting started with. And as I say, it makes you an investor. It gains you that experience. So yes, very positive on the roundups feature. We got a good few questions about the lifetime ISA. And this one specifically said, if I already used my lifetime ISA for a house deposit, should I keep paying into the lifetime ISA or pay towards a stocks and shares ISA instead? Now, for anyone that's not come across it, The lifetime ISA is a government incentivized savings product. And basically that means you can put in up to £4,000 per tax year, and the government will top that up by £1,000 if you maximize out that 4,000. They will give you a 25% top up on your savings. You can use that for two things. You can use that to purchase your first home up to the value of £450,000, or you can use it for supplementing your retirement income. So you can access that money from your lifetime ISA at the age of 60 if you don't use it to purchase your first house. Now, it is important to say you get a 25% bonus on the way in. You also get a 25% penalty on the way out if you do not use the lifetime ISA for either of those allocated purposes. So if you don't use it for buying a first home and you don't use it for retirement, you get a 25% penalty on the way out. The way that that works is you actually lose some of your own money as well as the government bonus when you are making what's called an unauthorized withdrawal. So the lifetime ISA is an absolutely fantastic product for getting you onto the property ladder and also for supplementing your retirement savings. You just need to be very sure and very careful that you will be using the money that's in your lifetime ISA for one of those two purposes. In response to this specific question, if you have used the lifetime ISA and you have gotten onto the property ladder, congratulations. Hopefully you've had a very positive experience. You can then keep paying into the lifetime ISA and using that to supplement your retirement savings as well. So there's absolutely nothing stopping you paying into your lifetime ISA again after you have successfully purchased a house. And then the final question that we got when it came to investing, is it safe? Can I lose money? So in the short term, absolutely, it is possible to lose money. If the market goes down and you lose track of your financial plan, you lose track of your time horizon, and you just get worried and you sell purely because the market has gone down, purely because somebody knocked on the door and offered you a lower price for your investments than they offered the day before, yes, of course, it is absolutely possible to lose money. Over the longer term, over 5, 10, 15, 20 years, investing in markets is incredibly positive and incredibly consistently positive. So the number one thing that you can do to make investing less risky is invest for a long period of time and keep coming back to that time horizon point. Okay, I'm going to leave this one up on the screen now. Thank you so much for joining. We have gone over the allotted time, so I don't think we're going to have any time to answer any of the live questions which have come in, which I can see we have a lot of. So thank you very much for the engagement as well. I perhaps mistakenly have put my email address up on that screen. This is something that we have always done from webinars, but given the thousands and thousands of people that we have registered and attending today, this may have been a mistake for this one, but please do give us some feedback. We want to do more of these sessions. We want to make them better every single time. So if you expected something that you didn't see today, or you wanted a little bit more information on any particular area, please give us the feedback, both good and bad. It is the only way that we can make these sessions going better into the future. So I will leave it there. Just a reminder that you will get a recording, a link to the recording of this session, hopefully in your inboxes in the next 24 to 48 hours, if I'm not over-promising there. And then the final thing I will say is thank you so much for registering for this. Thank you so much for attending if you're doing so live, or if you're watching back the recording. It makes us feel that we are doing the right thing by putting on sessions like this and hopefully making people more confident investors over time. So thank you very much. I will leave it there.